That does mean the scope for a sharp increase in the 10-year Treasury yield has been reduced somewhat. Our base case is that has always been that in response to the fiscal stimulus this year, that the 10-year Treasury yield will probably be range bound between 1.5 to 2. And so at this very moment, we are at the lower bound of that range. And therefore, in terms of our fixed income portfolios, we are still somewhat cautious on duration. And we do think that there is scope for the yield curve to steepen further in the second half of this year.
Steepen to what extent? Because I think the consensus running there is 2%, but there are enough market participants who believe that the overshoot could get reflected in the yield crossing that mark.
We think that that is possible maybe next year when we potentially see further spending on the infrastructure plan, et cetera. But this year we are sticking with our forecast for 1.5 to 2. I think earlier this year in the first quarter, the market did try to test the Fed's resolve in terms of their reaction function to higher inflation, incoming inflation data. But as we saw in recent weeks, I think that has sort of worn off a little bit as market participants have now gravitated more towards the Fed's narrative that the latest bout of inflation is likely transitory and not going to be something that will be out of control. And so the recent decline in Treasury yields has really been a decline of real yields because, as you see, inflation break-evens have not really moved all that much. So I think that some of that testing of the Fed has passed somewhat. And, you know, inflation this year is also going to be distorted by base effects. As you know, the next few months inflation data is actually going to be more noise than signal. But as we get nearer towards the fourth quarter, that's when we will truly have a better idea of true underlying inflation may be in the United States.